Good evening. On a beautiful fall evening in the Greater Toronto Area, my name is Paul Tyers, and I'm going to be the moderator of this evening's presentation. Just a couple housekeeping things. If there are questions along the way, at the bottom of your screen, if you hover down at the bottom, you'll see Q&A, and feel free to put in any questions along the way. Our presenters will optionally choose to answer some of those questions throughout if they feel it's appropriate, but at the end there will be a Q&A time period. In addition, at the end there will be an opportunity to ask questions verbally, and so I would encourage everybody to do so. Now, most of us are keenly aware of the impact that COVID-19 has had on many valuations of public REITs. And some of these people on this call have seen a detrimental impact on their private real estate portfolios. Nevertheless, where there are problems, there are often opportunities that emerge. I believe that property technology is one of the emerging opportunities that my hunch has been accelerated by the current pandemic. Without any further comment on my part, I want to introduce David Harris-Collada, whom I have known for many years. David, take it away.
Thanks, Paul, and good evening. It's a pleasure to be here with you and a chance to introduce Greensoul PropTech Ventures to you and our new fund, Fund 2, which we've launched earlier this year and are heading towards our first closing. We're going to be introducing each of the four partners and one of our colleagues, Rob Smith, our VP Technology, to you this evening and going through a number of slides, but we thought it might be a good way to start to share with you a video that we've recently completed that introduces our new fund. And actually, you're going to be the first ones to see it. So we're quite excited to do this. I'll just get it queued up here for you.
Greensoul PropTech Ventures, our success combines expertise and collaboration.
At Greensoil, we're energized by the opportunity to help digitize and transform the real estate industry.
Our limited partners are forward-thinking real estate owners, managers, developers, and investors with over 200 million square feet of property across all major segments and geographies.
My family's been in the development and management of real estate, primarily residential, for over 65 years.
Dozens of real estate companies and asset owners with more than $5 trillion under management have signed net zero carbon commitments by 2030 and 2050. This will only be made possible with PropTech.
Artificial intelligence, machine learning, PropTech. How does FinTech come into real estate?
At Greensoul PropTech Ventures, we balance our domain expertise and industry relationships with the experience to know how to carefully assemble a group of investments into a portfolio to deliver top-tier returns to our investors.
Thanks to our team's diverse domain expertise and our relationships with our industry partners, we're able to de-risk investment opportunities, very often through hands-on pilot and demonstration projects.
When we started Greensoul, we already knew that we didn't have to choose between making money and making an impact. We can do both. Less carbon and more profits. That's our vision for PropTech, making this world a better place for us and for future generations.
But to truly build value as venture investors, we have to build companies. And so we partner with our entrepreneurs to build their businesses, leveraging decades of experience as ourselves as entrepreneurs and as investors.
At Greensoul PropTech Ventures, we help our partners address the real estate challenges of today with innovations designed for tomorrow's real estate companies.
Join us in building the next generation of PropTech winners as real estate goes digital.
So at this point, I'd like to pass the baton over to our co-founder and chairman, Alan Greenberg, to talk a bit about the genesis of Green Soil and our PropTech venturing activities. Alan?
Thanks, Dave. Nice to see everybody virtually today. Just a little background. My partner Guidon and I started Green Soil back in 2011, initially to invest in food and agrotech based in Israel. We decided in 2014 to launch our second fund, which was going to focus on, at the time, we didn't know what property tech was. We called it Building Innovation Fund. And our concept was that we would invest in anything that would help make real estate more efficient, whether it be green products or new hardware, software, workflow softwares, and some interesting products, hardware products that are enabled by software. When we started it, I call it PropTech 1.0, there was a lot of low-hanging fruit. And over the course of our, from 2015 to 2020, we've invested in 12 companies. 11 of them are still active and are growing. And then about a year ago, we started to talk about starting a second fund as we ran out of fresh investment funds. And we started to see some big changes happening, and we call that PropTech 2.0. Much more sophisticated products, services, softwares, artificial intelligence, machine learning, algorithms, really changing the way as real estate starts to digitize. If I were to use, because I'm up here north, talking about water, you know, what we saw was a ripple in the water back in 2014, 2015. And over the last 5 years, we've seen a huge investment in our industry. And we now call it a tidal wave. This is the way things are going, and we're happy to be part of it. Dave?
Thanks, Alan. And if I could ask Guidon, the other co-founder and one of the managing partners, if you could give the folks an overview of the firm.
Sure. So as Alan said, and by the way, good evening to all of you. As Alan said, we started our Green Soil PropTech ventures in 2014, initiated the first fund in 2015. By then we still called it Green Soil Building Innovation because PropTech was not yet a known industry as it is today. Our first fund was $59 million. We have invested most of those funds, and the funds left are for reserves to keep supporting the companies we have. Our companies, and we'll show it to you in a moment, are making great progress, and we are on track to become one of the first quartile funds around. The unique thing of our fund is in a few things, and again, we'll talk about it going over this presentation, but one of it is that we have 4 partners that have a very different but synergetic background. 2 of us, Alan and Jamie. Jamie will introduce himself as well in a moment, coming from a very deep real estate background. Alan still being active in real estate, which allows us to get the state-of-the-art real estate information from the industry. And Dave and myself coming out of a venturing M&A and really the deal-making background. And that is really a great combination. The other very unique part, and again, we'll talk about it in a moment, is that our fund is working very closely with the investors that are themselves owners of real estate. It gives us the ability to take the technologies from our portfolio companies into the buildings. So it's added value for the portfolio companies that can deploy their technology, and it's added value for the investors that get access to the innovation.
Thanks, Guidon. Alan, can you maybe give some of your background, and we'll let each of the partners introduce themselves as we go through our team.
Sure. So my background, I'm part of the Minto Group, founded by my father and my uncle back in 1955. I think most of you have heard of our name. I resigned or retired from Minto as part of a family planning exercise 9 years ago, and started into venture capital, as I mentioned, with Guidon at the time. I branched into some US real estate on my own in 2016. and I've been back developing in Toronto since 2018. So I am active as a real estate developer, as a developer of right now rezonings and apartments, and trying to stay up to speed on really the impact of the COVID that it's going to have on the real estate side, but I think it's going to have a tremendous positive impact as we move forward on the property tech side. Thanks.
I do apologize. The neighbors upstairs started just drilling, but I'll do my my best. So I have my background mostly in venture capital and in M&A. As you can hear from my accent, I was not born in Canada. I was born and raised in the Netherlands. After high school, I moved to Israel, where I spent most of my career, mostly in venturing, corporate venturing, M&A. I spent 7 years with Royal Philips Electronics. I led all the business development activities in Israel, all the minority investments, M&As, and my last 2 years in corporate life, I was responsible for all M&A worldwide for one of Philips' 4 divisions. Invested some $2 billion, then got a little bit bored with corporate life and started my own activities. And as Alan just said, in 2011, co-founded GreenSoil.
Good evening. I'm Jamie James, and I got my start in real estate in 2002, working with my father-in-law's business in Toronto. There, he owns with his brothers a vertically integrated high-rise condominium development company and related companies. And I was brought on as a sustainability and green building advisor, which I did with them for off and on for 10 years, and also joined a boutique development company where we acquired brownfields in various Western cities and built aspirational green communities on them. And that's how I got the bug for the technology side and started to see how technology was going to enable innovative and forward-thinking developments. So I set up a small micro VC to start investing at the intersection of clean tech and real estate, and had some interesting investments that were quite successful because we were investing only in technologies that we were actually deploying. So we had a sense of how they were going to be received by the market, and we were also able to accelerate their adoption by the market. I did that through till about 2014, when I had the pleasure of meeting Alan and Guidon, and joined GreenSoil Building Innovation Fund, the first fund, as managing partner.
Thanks, Jamie. And I'm Dave Harris-Collada, also a managing partner, and I've got a 20+ year track record in venture capital and also in technology, having worked inside some technology companies, both big and small, some large, very large ones, including Cognos and OpenText, and also a couple of startups, one of which ended up going public, a company called Eloqua, which was then sold to Oracle for almost $1 billion. And in fact, the second largest Canadian venture-backed exit since the crash in 2001. So I've had some success both as an entrepreneur and as also as a venture investor. Spent some time in clean tech and also in software and IT investing. In the last couple of years before joining GreenSoil, was chief strategy officer at a prop tech company, and was seeing firsthand the huge demand that's pulling these technology solutions through and into buildings and into the built environment. So when GreenSoil approached me about this role, I was really excited, and it's a terrific fit. Rob is also with us. Rob, can you introduce yourself?
Absolutely. Good evening, everyone. So I'm Robert Smith. For 18 years, I worked for Alan as the Director of Innovation for the Mental Green team. And then about 6 years ago, I joined GreenSoil. So one of my major roles is I do the technical due diligence for any opportunities that we're looking at investing, and then provide recommendations to the investment committee. I also work with the portfolio companies once we do those investments. So I help them on business development, giving them technical expertise and advice up here in Canada. And I also work closely with their LPs to see if there's any opportunities that we can implement those technologies into their portfolio. So I have, I guess, about 30 years of experience around technology. I love technology. I understand green buildings, and it's a passion of mine.
Thanks, Rob. And we're just really, it's a real privilege to have Rob on our team, because unlike most venture firms who really just have a handful of people focused on making investments and managing investments, we have access to about half of Rob's time. And the other half of his time, he's actually deploying technology into buildings. He's still working in the building industry, both for some of Alan's buildings and others as well. And so that keeps our market knowledge fresh, as well as, of course, Alan's ongoing development activities while we work on our investing in parallel. We also have a deep bench with Anvesh and Malcolm being with the team for almost 5 years each, respectively. And as we grow with this new fund, we have really only one spot to fill, two spots to fill, one more person on the investment team, and then a full-time VP finance. So that's the team. I wondered if Gidon, if you could give the snapshot of the fund.
Sure. So as we said earlier, we have a first fund, $59 million. Our new fund is going to be bigger. Our target is $125 million US. We are on schedule to get to a first closing somewhere between $30 and $40 million US again, hopefully towards the higher end within the next 30 days. We're very proud that PSP, one of the largest Canadian pension funds, is our cornerstone investor. And for them, this is not just a financial investment, it's much more strategic investment. They have a lot of real estate assets under management. And for them, the relationship with Greensill is really to make their own real estate more efficient. So our focus is on PropTech. In a moment, we'll show you a little bit more what that includes. Stage-wise, we will invest probably somewhere between 80 and 90% in companies that are raising their Series A, Series B equity. And the reason we're doing that, because we really want to work with companies that are out there already in the market, that have a product, that have a service, so we can implement it immediately. We are mostly focused on North America. In the first fund, we did 100% Canada and the US. In this fund, we also have a 25% allocation for Western Europe and Israel. We will invest mostly in preferred equity. There will be cases where we invest in a convertible note, but with the aim to then convert it back to equity. Our ownership target is between 20 and 35%. We really want to be a substantial minority investor. And by substantial, it's not only the percentage, it's also the fact that we will almost always take a board seat. And then always we will be very actively involved in the business development and the governance of the company. If we cannot have an active role there, we won't invest. And last and not least, as we said earlier, we have a fund team that's been working together with the combined background of real estate and venture capital.
Thanks, Gidon. And we can hear live some of the joys of working in buildings and PropTech with the noise going on in the background. And that building, by the way, that Gidon is in, Alan owns as part of his ongoing real estate development activities.
Yeah, I think the neighbors were so nice to do the work in the evening, so
exactly. Yeah, they just didn't know that you were pitching a bunch of investors tonight. So let's talk a bit about our investment thesis at a high level. We have four main legs to this stool, and the first is we are 100% focused on PropTech. The venture capital industry is becoming more specialized. It has been a generalist industry historically, investing in any interesting technology that VCs could find, and it's becoming much more diversified as folks in terms of the industry, in terms of the venture investing firms. And one of the biggest specializations is vertical focus, and we are focused on real estate and real estate only. And that gives us a real advantage versus other venture firms. And one of those big advantages is the next piece, which is how we leverage our relationships with our limited partners, most of whom own real estate or manage real estate or develop real estate, and our broader real estate industry relationships. And as we'll hear a little bit more in the next slide or two, how we work with our real estate industry colleagues to validate our investments to ensure that they're demand driven, and how we help our portfolio companies grow through introductions and business development. The third piece is making an impact on the environment through reducing the real estate sector's carbon footprint. It is a massive consumer of carbon, emitter of carbon. And as Alan and Jamie have shown through their decades-long careers of implementing these technologies into buildings, they have a significant impact on the profitability of the buildings, and they also help with the environment. And that's something we believe is super important and a good way to combine profit and purpose. And then lastly, we are professional investors. We have top-tier track records of making investments in private companies. We know how to do it. We know how to balance risk with reward in terms of the technology, the stage, the geography, to build a portfolio in a way that delivers great returns, taking on enough risk to get those high returns, but to do it in a smart way and structure the deals in a way that maximizes that return. And I think maybe, Gidon, you could just sort of skip to this next slide as we're trying to kind of fast track these, if that's okay with you.
Absolutely. I think the only thing these slides are saying is that this is not only a nice sector to invest in, it's also growing very fast. When we started, it was about 6 billion. Today, it's already over 25 billion. And what we can see here is that we also believe there's still a huge potential to further grow. When you look, and that's what we're showing in this slide, the size of the venture capital being poured into PropTech as a percentage of the GDP of real estate, and you combine it to other sectors like health tech and fintech, you see there's still a lot of potential for growth. If we would go to the same ratio as fintech, that would mean that we can still grow this PropTech sector 9 times. So we do believe there's a lot of potential for further growth.
And interestingly, while we're a much more recent venture category than fintech, we're almost as much in terms of dollars, 27 billion versus 32 billion. And yet, as the slide shows, still a fraction of the sector that we're putting that capital into. Jamie, could you talk about our advantage and how we work with our LPs?
Sure. This was alluded to by Rob in his introduction. We try to create this this virtual circle of value proposition that begins with deal flow that comes partially from our partners who are in the real estate world, and they're constantly seeing opportunities that are being pitched to them, and often they'll provide them to us as leads. And then Rob and our team will get involved in dissecting them and understanding them from a technical point of view. And then the next step is to go back to our partners and see who is interested in working with us on pilot and demonstration projects. And through those steps, we're able to triage and de-risk investment opportunities and see where the investability of a lead overlaps sufficiently with the relevance of a lead for a broad enough segment of the market. And then once we've made a decision because of that intersection of merits, we will look at helping those companies to grow. And again, that's where part of Rob's job comes in. He's been in the real estate industry, and as have others on the team, and we understand the dynamics, and we understand the sales cycles and the process for procurement, and we act as sort of an adjunct business development team for our portfolio companies by specifically targeting key LPs or other real estate partners in our network, and promoting them and helping them get to that sales point and accelerate that process for them. So it goes from lead inbounds to testing and making an investment, and then ultimately helping to promote those companies so we can accelerate to a higher value exit. And the value proposition is both for the LPs, because we're having that additional de-risking and promotion, but it's also to the portfolio companies that we're investing in, and that and they recognize that usually by giving us an advantage in the deal process, whether it's against competitive VCs or otherwise.
Yeah, and maybe Rob, you could just share what this slide is showing and how you've worked with one or two of our companies to have them engage with our LPs.
That'd be great, David. So as an example, one of our LPs is Hallmark, and they approached us about Carta, which is our 3D modeling company using LiDAR technology. And they wanted a model of building 50,000 square feet that they recently acquired. They had some proposals, and they allowed us to test the technology out with them, which they found we could do it in 20% of the time and half the cost. And since then, now they go to Carta for any future acquisition they make. Another example is Amatis. So we piloted Amatis, which is a wireless lighting controls company with KingSet in Toronto. And since then, you can see Minto is using it, Tridel, Grosvenor, and Golden Properties. And then,
thanks, Rob.
Oh, okay, that's great. Yeah.
Oh, sorry. Yeah, I'm going to skip over this one, Jamie, I think just for the sake of time, but on questions, we're happy to get into more detail on why we think this is an excellent time to be targeting technologies that reduce carbon in the built environment. This slide is talking a bit about our deal flow, and of course, raising the capital is mandatory to have a fund, but we have to be able to find great deals into which to invest that capital. And we've shown over the last 5 years since we started that our deal flow is really quite unique compared to other VCs, particularly those that don't have the real estate connections that we do. And so all the top 3 of these arrows are all proprietary sources. And we've seen, this is 1,000 plus, it's probably 1,200 deals invested in 11. As you can just sort of see the degree to which we are able to find interesting opportunities, and of course how picky we are as we screen them. And as Rob was talking about on the previous slide, we use our relationships with our LPs both to screen those, but also to find those deals, which gives us a real interesting ability, and as well as to sort of get to know some of these entrepreneurs before they're raising money. In some cases, we'll partner with them without them ever really going out and marketing around, because we're just a logical choice. And that's really, our mandate is to be the prop tech VC of choice for entrepreneurs, combining the strategic benefits of having those deep relationships in real estate, but not being a strategic investor and having some kind of ulterior motive that may or may not be consistent with the entrepreneurs. We are an independent firm. We only make investments to optimize returns. And so we combine the best of both worlds in that regard. This is a listing of our current portfolio companies, which we won't have time to go through in detail. Happy to take questions on them. Maybe Jamie, you could discuss a little bit about sort of our strategy of investing in some of these companies and building up the size of them, and then we'll talk about the performance on the next slide.
Maybe I'll just start with the top one because it's also our largest investment, but it didn't start out that way. One of our 2 strategies is to invest in early stage companies, although it might be a minority of the overall portfolio at first. The intent is to build those, to build up our investment over time. And so we secured a position in electric power early on with a very small investment of $250,000, following the installation of their behind the meter energy storage solution in a net zero penthouse that was being developed down on the waterfront with Heinz and Tridel. And it was right on the heels of the announcement by Tesla that they were coming out with a home energy storage system. And so we thought that was going to be an interesting marker for the start of a new segment that is in home energy storage. At first, we weren't entirely sure how that was going to evolve. So we made a small investment. It proved itself out technically in the application that we first installed it in. And then through a series of challenges to the company on achieving milestones, we continue to follow on with our investment to the point where it's our largest investment. And it's sitting in a very, very healthy position vis-a-vis one of the fastest growing markets in North America, that's being driven by so many different factors, from regulatory to natural disaster resilience, and taking advantage of some of the commodification, the commoditization of renewables, and the increasing attachment rate of storage to solar in the United States. So that's one of our models. Start early with a small investment and then build our way up. And then other ones like Gobi, the second one, we started with a relatively large investment, and we've played more of a governance role in helping to shepherd them to successive expansions of their software platform, from real estate measurement and monitoring to ESG reporting for, at this point, private equity funds in general. We don't have time, as Dave said, to go through each of these, but we'd be happy to. I just think those are effective bookends that express sort of how we implement our strategy.
Yeah, thanks, Jamie. And hopefully you've had a chance to look at some of the descriptions of the technologies, and each of them has a really interesting story. They're like our children. We're very proud of all of them. And we'd be happy to talk to you about them in a bit more detail. But what's interesting is the diversification of the technology. Some of them are very hardware based. Some of them are very software. Some are hybrids. They all are very advanced, have very strong intellectual property. They're geographically distributed, US and Canada. And by stage, almost all were, with maybe one exception, revenue generating when we invested in them. And as we put more capital in, and you can see here on this chart, it shows the performance in terms of the valuation of our investments since we invested in them. The largest investments are the ones where we're expecting the highest returns. So the way to look at this chart is we've normalized each of the cost base, our original amount of capital we put in, as 1x for each company, and then showed you the increase in valuation, both in terms of a fair market value increase, which is this blue section for a number of them. And that's come from another investment that's come in after ours at a higher valuation, placed by an independent investor other than us, or has been audited by our auditors. And then the third and fourth bars are showing our expected return based on the growth of the company, the multiples in the marketplace, and ongoing discussions with potential acquirers, and in one case, a potential IPO that we're working on. And you can see here that we're in a position right now to deliver 2 to 3x on the money our investors put into the fund once we've fully realized on these investments, which would generate a gross IRR on a base case of 15 to 20% and over 35% on our upside case, which would put us in the top quartile. So top 25% of funds of this vintage year in the base case, and top decile, so top 10% of funds in the upside case, which is really great performance. And also you can see here, this yellow bar shows our first exit. We sold a company called Honest Buildings last year to a company called Procore. Procore is actually one of the biggest prop tech companies in the world. They filed to go public, so their information is all public now in terms of hundreds of millions of dollars of recurring revenue. They were valued at $3 billion when they bought Honest Buildings from us, and they're now valued at $5 billion. And that represents that blue increase on our investment. We still own shares. We took cash back plus shares in Procore when we sold the company. So we're still looking for some additional value from that investment over time. We still have significant reserves for follow-on investment. That's the other thing that it's important to look at this. One of the big success factors of a venture capitalist is the ability to put the capital in, take the appropriate amount of risk, secure follow-on investment rights at advantaged prices, and then put that capital in as the company performs. And so you can see here that our bigger investments, we still have some capital reserved for them because they're still growing. And some of our smaller investments, like our most recent one, ThoughtWire, small investment to start, but a large reserve for follow-on. And that's one that if they continue to perform, we'll be quite eager and have the rights to put more capital in as time goes forward. So just to give you a bit of a sense as to how the portfolio is emerging in this respect. And I think we'll skip over this and this because we've talked a lot about our LPs. This is some of the company that we keep. These are co-investors with us. The venture capital is a club sport. We think of all these firms as sort of co-opetition. They are competition in some respects. Mostly they are cooperative with us. They're partners. We invest with them. We invest together with them into companies. And the top half of the slide are all strategic investors. Some of them, most of them are real estate companies. Some of them are not. And you can see here Microsoft and Amazon and Shopify, First Capital. These are financially oriented or technology oriented companies that are investing in prop tech. The rest are some very recognizable household names in the real estate field. And then the bottom half of the slide are all financial, sort of more mainstream VCs, if you will. And it's important that we are able to assemble syndicates of investors from investors in both categories so that we can have enough capital to fund them through to their growth potential and through to exit. And then secondly, these all represent terrific sources of deal flow for us in Fund 2, the advantage that we didn't have in Fund 1. Jamie, I wonder if you could maybe just talk a bit about some of the new areas, and Alan, of course, jump in, that we're excited about as we look at PropTech 2.0 and with our new fund.
So we started off in the center of this graph here, looking at advanced materials, building controls, smart systems, workflow optimization. That's where we came up with our balanced approach to smart devices, network devices, hardware, software combos, and pure software companies. But as you can see, that has radiating out now and touching on multiple other verticals that are coming to bear in the real estate industry, from carbon reduction and climate tech related technologies that are going to be driving transactive energy systems and smart cities, through mobility and looking at how the way people get around in a smart city and connects to building and real estate infrastructure, and financial mechanisms that are going to improve the performance of and adoption of technologies, which includes things like insurance technologies, which we're starting to see already having a significant impact in the adoption of PropTech. And then, of course, the acute problem of COVID is driving some very interesting decisions about the best way to manage workforces and floor area densities. And we're actively involved in deal flow around that topic at the moment. And so we've got a much broader range and a much broader lens that we're looking at the market from. So it started off relatively narrowly in Fund 1 because PropTech wasn't even a word at the time, and now it's much it's advanced significantly, and lots of new opportunities. Lots of new startups have realized what's happening in the industry, and so you're seeing the ecosystem really evolve quickly.
Thanks, Jamie. And of course, happy to take questions on these. If you want to put them in the chat, we're happy to answer them as we go or at the end. I think the bottom line here is that PropTech is becoming, it's growing in interesting ways, and there are overlaps with these other adjacencies like fintech, for example, and COVID. We haven't talked a lot about COVID. I think Alan did at the beginning. This is driving the need for some technologies that don't exist today, or they exist but haven't been adopted at scale, and now they have to be. So we actually have that as another one of our key themes for Fund 2, is ensuring that we're investing in companies that are benefiting from the spend that real estate owners are needing to invest in to be able to deal with COVID, whether it be ensuring the appropriate distancing or capacity of their buildings, or actually in the healthcare sector, where they're having to deal with the consequences of the pandemic and the technologies going into those healthcare facilities. Alan, did you want to add some things?
Yeah, I think the only thing, I wouldn't limit it just to the building owners. It's also the people that are working or living in the buildings or interacting with the buildings. So, or land. So it's not just,
great point.
It's not just for owners themselves.
Thanks.
Dave, do you want to address maybe the point that was raised?
Oh, hang on, let me just, multiples paid versus exits. Yeah, happy to do that, Paul, thanks for the question. We're seeing in the venture space, we're actually quite disciplined around our investment entry multiples. We structure quite investor-friendly deals for the most part. And we have the ability to do that because we bring value to the entrepreneurs that other investors don't. And so I would say that our entry valuations, it depends on the quality of the revenue. We typically value it on a revenue basis. The best revenue is recurring revenue, so ARR, annual recurring revenue. And market multiples for venture deals in the Series A, B range, which is sort of 2 to 10 million a year in revenue, is in the, I would say 3 on the low side, up to 5 times revenue. We're often getting it less than that. And then on the exit side, it's, I would say 5 plus, and it can be much higher than that depending on how strategic the investment is to the acquirer. And in the public markets, you know, the multiples are in the 8 to 10 range for bigger companies. So, you know, that's sort of, there's some multiple expansion, typically from 2 to 3 to 4 to 5, and conservatively, but on the upside, it can be even north of that. So of course, we're growing the companies. Typically, we're looking at, you know, a double or a triple double. Often when we get involved, you know, the revenues will triple in the first year to the second year, often triple again, if not then a double. And then they'll grow at 30 to 50% a year from there before we exit. That's sort of the typical growth trajectory. So we're getting, you know, year-on-year growth of revenues. We're getting margin expansion, typically from 65% to 75 to 80%, the gross margin level, EBITDA from 0 or negative to positive. So we're getting all those financial improvements as we invest and grow the company. And then yes, there's also multiple expansion. Although we don't, I would say we don't bet on the multiple expansion as strongly as we bet on the growth, to be perfectly honest with you. Multiple expansion tends to be sort of the cream.
And maybe just to continue that, and Dave, on the next slide, and I'm not going into detail. Here they are again. Very lucky.
Just in time.
Best timing ever. I think the most important part I just want to convey is that it's of course nice to invest, but at the end we want to make our exits. And when we invest, we already look at the exit targets. Who would buy this company and for what reason? And that's an important part of the analysis we're doing. We're looking both at large players within the real estate sector, but also in other sectors or more general sectors, software, hardware, that want to get a position in real estate. If we don't have a very strong case where we understand how this exit will happen, again, then we won't invest. Dave.
Absolutely. Thanks, Gidon. And you can see here, there's the diversification of these M&A buyers. And this obviously is super important for us because we want to have multiple parties to sell to once we invest in a company. And all these names on this slide, we've seen them do deals in PropTech. So this is not just sort of aspirational, this is based on real data. And I think we'll probably end here. We might go to one more based on questions, but just to give you a sense, we alluded to earlier, the fourth leg of our stool on our thesis was intelligent portfolio construction. So this is what we mean by that. We set out at the beginning with a certain number of slots that we're intending to fill in our fund. And so this is based on 150, but let's say it's 100 to 125 is probably a more likely range for our fund. We're looking at 5 to 8, let's say 5 to 7 core investments by the time we're completed our investment activities, where we'll start with $3 to $7 million in each of those investments. We'll reserve probably 1x of that, maybe even more for follow-on. And those will be companies that are Series A, Series B, so they're in revenue with customers in revenue, growing up from sort of 2 to 5 million up to 10, 20 million in revenues in those core areas that we talked about. We also will do some seed investing, which is that category on the right. We did that in Fund 1 quite successfully, taking some earlier stage bets in companies that are at the beginning of their commercialization. They have maybe their first customer, a working product that we can pilot and due diligence, test with one of our LPs, and then use our relationships to really sort of help them get from that early stage to a more growth stage. We'll do some of those. We'll put smaller bets in. We'll see how they do. If they succeed, we'll put more money in. If they don't, we won't. And some of those will graduate to core status over time. We're adding this new category in the middle we're calling emerging sectors, and that's because of this PropTech 2.0 trend that Alan identified early on. And some of these areas are new, and how they're playing out with respect to PropTech is still shaking out. And so our strategy here is to take medium-sized bets initially. They may be more mature companies, but the spaces are a little bit more at an earlier stage. And then we'll see how that plays out. Some of those will graduate to core status, put more capital in as we see how they succeed. So that by the end of the day, we'll have 2/3, probably more like 3/4 of our capital in those core investments. And that's in the venture business how you make money, because we're taking enough risk that some of our companies will fail, and that's acceptable, that's necessary, which means that the ones that succeed, we need to have a lot of capital in them so that they can make up for the losers and deliver a high returns to our investors. And the way to do that is to make sure we put a lot of capital in our best performing companies. So that's our strategy. That's how we set out to do it. We're quite disciplined. We review our capital roadmap monthly to make sure that we have enough capital, and we've reserved it for each of those companies as we evaluate their performance on an ongoing basis. I think I'll stop there. Happy to go through a few more slides, but wanted to pause and see if there were any questions, and then we could sort of go from where the questions lead us. Paul, did you want to open it up at this point?
Sure. And I was thinking that if anybody would like to ask a verbal question, go to the bottom and put your hand up. I think there's a hand up button there. And Shelby will take the people off mute. And maybe just to get it kicked off, if I may, nobody anticipated COVID. And what, if anything, has been the impact of COVID on your first fund?
Yeah, great question. Who'd like to take that one? Jamie, do you want to start? And I'll put our COVID slide up while you're talking.
Well, at first we were very concerned because of the lockdowns, and we did a quick assessment, a rapid assessment of our whole portfolio in that context, and we determined that those hardware heavy companies were going to be more impacted than the pure software ones, because you have to have access to properties, and you have to go in there sometime, very often, install and commission, et cetera. And the pure software platforms are more just, you plug in and you can go. But we were pleasantly surprised, actually, that that those companies that required installations have actually done well enough during this period, because a number of landlords are taking advantage of some of the downtime to do the kind of retrofits that they've been meaning to do but have been waiting for churn. So the impact, although there's one company in particular that works in residential buildings and has had a really hard time accessing, but they've got sufficient runway that we expect will outlast the acute aspects of the pandemic. And the other ones are doing well, and some are doing the software companies are doing very, very well. I'll pass it back to Dave, because we've extrapolated from that experience to chart a strategy for Fund 2.
Yeah, thanks, Jamie. And we developed a series of attributes. This is just a summary of them that we used for one investment in particular that we made right in the middle of COVID, and decided to move forward, but decided just to adapt how we were going to approach it. And we've been using it as we look at follow-on investments into our current portfolio, and we'll be using it in Fund 2 as well. And I think, a couple of things here. One is that I think, as I alluded to earlier, it's both which markets the technology is being sold into. We might have a preference now for certain markets that are actually benefiting strongly from COVID, like anything to do with e-commerce. So distribution centers and data centers, those kinds of logistics oriented, they all use buildings, and they need technology there. The technology that manages their buildings and that manages their internal operations are, to this day, still very much separate, not coordinated, not optimized. And there's a lot of technology that's being applied to use particularly machine learning and sensors and the cloud to be able to bring those systems together and optimize them to be able to scale rapidly. For example, the largest distribution center operator in the world in the United States is going to be expanding their footprint by 40% in the next 12 months. So that's an example of where there's a big growth market, and we're looking to deploy technologies into that. Second is having resilience, right? So we call it COVID resilience. What technologies can help commercial real estate owners, residential real estate owners that are having some headwinds that they're facing, deal with the crisis, to be able to minimize their risk, their downside, and then as things turn around, be able to benefit as the economy recovers. And then there's other sort of more financial oriented items like the revenue model. Recurring revenue is super important as venture investors, so that the technology company doesn't have to resell that revenue every year. They have it tick over on a regular basis, which may be software, which is the classic SaaS, software as a service, or where the market's moving is bundling hardware and software together and selling a subscription to that, where the customer is not buying a widget, they're buying the data that comes off the solution. And that's using a piece of hardware, which is usually a sensor, maybe other things as well, cameras, etc. And then all the all the technology behind it is usually in the cloud that's taking the data off those sensors, analyzing it, and then producing reports or predictive assessments, and the ability to remotely or automatically control certain systems based on information. So those are things that are now being bundled together, being sold on a monthly basis. So for us as investors in those companies, we love that, because every dollar, every sales dollar, every dollar that goes into R&D, we have a longer annuity that comes out from that on the other end. So those are some of the things that we're looking at for Fund 2.
And just maybe one observation I would like to add from a little bit of a different angle. But investing in the COVID era also means that we are starting our fund in a year that's not a great economic success. And if you look at the predictors of success in venture capital over the last 30, 40 years, there is an enormous influence of the vintage of the fund. What fund were you able to start a fund? So starting a fund in an economic downturn is one of the predictors of a more successful outcome.
Is that a matter of just less access to capital, so you've more to choose from?
It's a combination of that. There's more availability. What we normally see in a downturn is that the valuations will go down. A lot of investors are keeping their capital for their own portfolio to support those companies. So for a new fund with new funds available, there's a lot of supply of very interesting opportunities at over the board, lower valuations.
Yeah, and I think the other point, which is related to that, is lower valuations, but also the entrepreneurs that are successful in building their companies through these difficult times are really the best of the best. And so we're optimistic both in terms of being able to get good deals and having capital where there may not be as many others, but also to be able to back very strong entrepreneurs that'll be tested through these very challenging times.
I think one of the proofs also through this is, the work that we did in late March and April, where we approached our portfolio companies and started to sit down with CEOs. Some of them have never really been through a downside. So I think we brought a lot of value to the companies, asking them a simple question. If you have no revenues for the next 18 months, how are you going to survive? So I think through this process, we've been able to separate who we think will be the winners and some that may not quite get the scale that they want out of what's in front of us. I think it's taught us a lot how to help companies grow in this environment. And talking to the CEOs of those companies, because a couple of them are just really growing quite substantially right now. Talking to them, to a portfolio company, and having two CEOs talk to each other talks about some of the benefits that we bring to the company we're going to be investing in. I think there is, Dave, there is an allocation question. I don't think we specifically allocated to what type of real estate, and I don't think we've allocated as to where within the broad picture of prop tech that we're going to be targeting. The one thing that we have outlined is geography. And the second thing we've outlined is our strategy of small investment, medium investment, large investment. But as far as where we make those investments and in what sector of real estate they're going to impact, it goes into our list. It has to be relevant. So we have to have LPs in that area of real estate. But it's not the only reason why we would invest, because it's for apartment buildings, as an example, or because it's for construction. Today, we can't come up with that matrix. We want to find the very best investments that we can find that will be relevant to our LPs, that our LPs can buy their products and help the portfolio company grow. Those are a lot more important than we're only going to be in apartments or only going to be in industrial, as an example.
And it goes, it's self-evident, but obviously those deals that cut across the segments are going to be more attractive to us than those that are limited to a specific vertical.
Yeah, for sure. And I think the other thing, just in general, that is probably good to point out is that we as venture investors, we need to be able to see a way that our capital can be used to the most effect in terms of scaling the business. And so in general, we found that consumer-oriented technologies is not our preference. As Alan mentioned, there certainly are technologies that are pointed towards the occupants, not necessarily the owners or the developers. So we're definitely interested in occupant-oriented technologies, but more businesses, right? Enterprise occupants as opposed to individual residential occupants, just because of the need for sales and marketing dollars to reach them and the difficulty to scale. But that's not to say that we won't do it. It's just that it's not our preference. It wouldn't be as high a priority for us. And then also, certainly commercial real estate, corporate real estate in particular, with COVID has been hit. And so the ability to have LPs in all these different categories, I put this slide up to sort of give you a sense, all of you a sense as to the diversification of our current LP base, which we'll continue to be able to leverage in Fund 2. We're adding new real estate oriented LPs in Fund 2. PSP, of course, very large real estate portfolio in a number of different areas, and 2 or 3 other large ones, Starlight, Daniel Drimmer's real estate organization based here in Toronto, and a couple of others that are coming in, one of which has already deployed one of our Fund 1 technologies. So, we're going to be expanding this network as we bring more LPs onto Fund 2, and we'll be following their lead in terms of where that demand is, but also making sure that whatever companies we invest in, that our dollars can help them scale and we can exit to make a good venture profit. Hope that answers your question.
Well, I think this has been an excellent overview of your fund, and thank you for taking the time to explain it in such detail. Are there any last minute questions before we, in respect to your time? It's been 1 hour. And are there any last minute questions that anybody has? Well, if not, I welcome anybody who's on this call that is here at the invitation of Wealth Stewards to certainly get in touch with your wealth advisor at our firm and have the discussion about your interest in green soil. And we'll be communicating with David Harris-Kalata in the near term, and all the very best with the rest of the fundraising for Fund 2.
Thanks very much, Paul. Yeah, thanks for this opportunity, and thank you to your clients and investors that were able to join us tonight. Have a great evening.
Thanks, everybody.
Thank you, everyone. Bye-bye.